Okay, good evening, guys. Welcome to this strategy school tonight. We're going to be talking about breakout trading. Again, a very, very important part of trading. It's all to do with markets building up momentum and trying to pick out where the markets break and see where they go. So it's one that I thought about quite a lot when I was writing it, and it's applicable to today's markets and any kind of markets. And again, we'll go through some good techniques of how to position yourself to the markets, the tools you can use. Now we can capitalize on these quick break and the volatility in the markets. Before I start, I'll just do the instant poll as always, guys. Let me know if you can hear the volume correctly. I'll put that on your screens now. Okay, so just let me know if the sound is too loud, too low, or just right. So the standard settings, so it should be fine. Okay, we're just getting one person saying too loud. Ryan, maybe you just want to knock the sound down a little bit. There's a standard setting. Everyone else saying perfect. That's great, guys. Thank you very much. Okay, so before we start, as always, need to read the risk warning. Now, spread bet CFD trading both carry a high level of risk or capital with the possibility of losing more than the initial investment. These products might not be suited for all investors and only intended for people over the age of 18. Please ensure you're fully aware of the risks involved. If necessary, seek independent financial advice. For education only. Content of the webinar is personal opinion of the moderator, nointrader.com. The content does not constitute financial, investment, or tax advice. You're advised to discuss your CFD requirements with an independent financial advisor prior to entering any bet. Intro.com is not responsible and disclaims any and all liability for consequences made during the session. Okay, so what is a breakout trade? Well, a breakout trade occurs when the stock, prices, asset class, whatever we're trading, exceeds previous determined support and resistance levels. Okay, so a long position to trigger when the price moves above resistance, short position to signal when the price drops below a clearly defined level of support. So markets typically get caught off guard by the price activity, and as a result, volatility and volume will increase when we see this breakout of the trading occur. So there are fundamental breakouts, and we've explained fundamental news in quite a lot of the live trading sessions, and really it all kind of revolves around things that happen within the market that are not known. So we all know about Adam Smith and Dow theory. The price action moves between relative support and resistance, and people buy and sell from each other at an acceptable price until new fundamental news comes into the markets. So a perfect example is when we trade non-farm payrolls on the first Friday of every month. We know that the market is waiting for this data, and it's going to form an opinion as this data is released. So we're going to get a break to the upside if it's a good figure, and a break to the downside if it's a bad figure. Because that's new news coming in to the market, which people make a snap decision on, but also position themselves for perhaps the coming day or week's trading, all based around this new information. So data releases is all the things that we look to trade that we know are going to have some sort of effect on the markets. So as I said, it's all about understanding the right kind of business cycle and trading cycle. So right now we're not really looking at inflationary figures. So we know interest rates are going to be kept on low in the US and in the Eurozone. I mean, there might even be a chance that the Eurozone might cut in the coming meeting. But right now we're concentrating on growth figures. So it's all to do with non-farm payrolls, all to do with GDP figures, and any of the kind of sentiment figures that are going to indicate the growth and sustainability within the markets. Okay. So again, when that data is released, it will move the markets, but again, it will move the markets from a technical perspective. So when I say that you have to be, when you have to be a trader, people always ask me what's the right kind of ratio. Do you just discount all fundamental news? Can you just be a purely technical trader? I know the appeal of that sounds great, that you just ignore and filter any noise and any new information that comes into the market and just trade the markets from a technical perspective. But I really don't think you can, to be honest. I would say that really, you have to be 70-30. So 70% technical with a 30% understanding of the fundamentals. Just because figures come out doesn't mean you have to trade them. But if you're not going to trade them, then stay at the market. Because then if you don't, then you're just going to be trading the market for no reason. So I'd definitely say that fundamentals are very, very important in the market, but they will always move within technical levels. So plenty of times now, guys, you'll have had the opportunity to see me trade GDP or non-farm payrolls, and I'll trade a non-farm payroll from a technical perspective, even after the data is released. So we'll do Fibonacci retracements, extensions, and you always get to see the lines on my chart, so areas of interest. So that's how I trade. If you've joined any of the trading clinics today, I was talking about the euro, Japanese yen. So it was, as I said, the market, we all had the same opinion the market was going to go up. But what people did not seem to understand was the market was probably going to push down and squeeze some longs out of the market before it actually went up. So what we did is we found some good technical levels that were good points of interest for the market of where it could push down to and find them extra buys in the market to then send it higher. So it's all about understanding how far a market can move and then being able to capitalize on that with the catalyst of the fundamental news and information driving the market up and down. Okay? So other things that are going to affect the markets and fall under the bracket of fundamentals. So your key speakers. So again, on the Trade for Life course, we've gone through every key speaker. So anybody like Ben Bernanke that speaks on behalf of the Fed, or Angela Merkel, who obviously is the Chancellor of Germany, who the powerhouse behind the euro. Anybody from England, Mervyn King and people as such. It's not really people like the President and the Prime Minister so much, to be honest, because they don't really control the kind of fiscal policies. They're just the thing ahead. So you need to know who moves the market. So it's people like Timothy Ginther from the Fed, names you might not have heard of. These are the people when they speak on the wires you need to listen to, because the market will interpret what they say and make a judgment call and send the markets up and down accordingly. Then there are things like geopolitical events. We know what the Arab Springs, we saw the effect that had on oil. And then there's things like natural disasters, things that just happen in nature, earthquakes and the Fukushima catastrophe. So again, that's man-made, I guess, but it falls under the bracket of a disaster. So again, all these things will move the markets up and down. So we should really know how this will affect the market that we trade and be positioned for it, because it is an opportunity to make money. And what I do find as well is that people can misinterpret the way fundamentals move the market. Fundamentals are always around, okay? So when you read the news, people are absorbing an opinion. People are building an opinion of what's said. So they're always going to be involved in what the market does. So you can never discount fundamentals. They're not always going to drive the market, okay, and move the market in continual trends, but it will have an underlying tone and set the tone to the markets. So we know that right now the tone for the markets in the big markets like the S&P, the FTSE, the DAX, the Eurostoxx, were dip buying. Okay, and that's because the underlying fundamentals is that we're going to have quantitative easing and we're going to get ourselves out of trouble. So it doesn't matter that that the markets sell off. They're going to find value because again, it's almost too big to fail. How bad can it be? So even with that dreadful non-farm payrolls we saw earlier in the month, where it came at 88,000, the market went down, but pretty much within 2 hours of trading recovered 80% of the losses, because we know that no matter how bad the economic situation gets, there will be that promise of quantitative easing, and the markets will do something about it. So again, it's understanding what cycles we're in and how the markets will move, and that's how to trade the breakouts. So breakout to the low side might be a double opportunity. Okay, if we hit some new fundamentals that, again, if we go figure-wise, maybe another bad non-farm payroll, so markets are going to go down, and that's an opportunity to sell. But then it's a good idea to pick the bottoms of the market and try and pick some value. Because how bad is this news ever going to be? I mean, nothing really disastrous has happened yet. In the UK, we bailed out all the banks. In the US, likewise. So really, if there was going to be some catastrophic bad news, I think we've had it by now. So it's a good idea to look at the fundamentals and how you trade them from both perspectives. So it's risk and reward when we're talking about any kind of trading. And in breakout trading, again, it's quite defined. Now, the way I look at breakout trading is you're trying to catch the momentum within the market. Okay, so it's very much like a momentum/swing trade. So if you're going to trade the breakout, then really you can't have your risk set too high. Okay, so your minimum kind of risk reward ratio would really be between, 5 to 1, I would say, because what you're looking to do is the market to gain momentum and to go with that volume. So the market shouldn't really retest your entry point, because if it is, it's not really trading that momentum. So what would generally happen if we see a big breakout? We'd see a big solid green or red, say maybe 5 or 15-minute candle to indicate that market is moving aggressively in that direction. And we will see some sort of pullback. And again, just go back to the basics of Fibonacci. We'll generally see a 32.8 or 50% retracement happen, but then the overall direction of the market continues. So very much like Elliott wave, very much like anything else we talk about in the markets that have cycles and have a directional move. We shouldn't be going back to your entry point. So really, it's either you're right or you're wrong. And again, it's never as black and white in trading as that. But really, if you're trying to catch the back of this momentum and the back of a trade that has technically or fundamentally broke out of some boundaries, then you need to be with that momentum. So the market should really go quickly in the direction you think. It might have some retracement, but then all the momentum will then carry on from that. So the biggest point I should make from when you're looking for breakout trades and you're looking for trading in this particular manner is to hold on to your trades for longer. So again, many times in the trading clinics, people have asked me how long, do you hold a trade for? And generally speaking, I would say that you have to, if you're going off hourly signals, then you have to wait for a minimum of 2 hourly candles to close before you get out. Because if you're right, other people are going to get on the back of this trade and push the market further. And again, if it is a breakout trade, it'll have extra momentum, and it'll be getting people out of the other side of the trade. So the market, was trending down, and then suddenly technically breaks up. It's going to be getting a lot of shorts out of the market, which will add to the overall volume and overextend the move. So what you have to do is let people get the profits out. Okay, and that will make the market come back down. Then other people come into the market to fill that void and then push the market even further. So really, again, when you're looking for these kind of breakout trades, again, wait for your 2 hourly candles to close, and that can be your potential exit. Or trade off your 15-minute candles. So every 4 15-minute closes, you get an hourly signal. But if we're going to be on the breakout trade and we're going to make some new highs or new lows, then each time these 15-minute candles close and we make a higher high, that's another signal there's still momentum and the market's still breaking out. Okay, so you'll hit a low, or a high, and people will naturally sell or buy into new lows, and that'll bring the market back. But then they'll be retested. The more times they're tested, the more the market then continues to break out in the direction that it originally started. Okay, so if you're trading comments, data, and events, let's say the risk-reward ratio, is a minimum of 5 to 1. You're going to be looking for, if it is going to move the market, it's a sustained big move. And if you're trading the breakout of a range, you need to keep it a bit tighter, because that's just a technical direction, a technical bias coming into the market. So if we're doing things like the market may break through a level, it might come back to it and retest that level. Again, the theory that support becomes resistance and then continue. So again, the point we're trying to make here is that when you're trading comments and data events, it will go in one direction, might retrace a little bit, but then it goes to the highs or the lows, because that's news, that's something new. If we're testing and trading breakouts or just technical trading, then it might well come back to your entry point a number of times, but it should, again, you should see the market acting and testing if that support and resistance is still valid, and then will move. So the real point of this is when you're trading breakout trading as in fundamental news, it will move quickly and in one direction, shouldn't come back to your entry point. But if you're trading breakouts of a technical perspective and a technical manner, they may well come back to your entry point and test where you entered the market, but then will slowly again grind and go, if it is a true break, to a new high or a new low. So it's just a slightly different way of trading that news, but then also being positioned in the right kind of way to understand how quickly the trade's likely to go on side and how far potentially it can go. False breakouts. So again, when you see these technical patterns, as I keep saying with trading, it's not knowing what everyone else doesn't know. Okay, it's not finding some secret formula using a 54-day moving average with an Ichimoku cloud. That's not trading. Okay, understanding the basics of trading, what everyone else is looking at, that's how we trade. So if you see, for this example, very, very crude drawing of a parallel channel, okay, we know that people are going to be selling the highs and buying the lows because it's a channel. But we know at some point any kind of sideways movement, any kind of sustained movement between support and resistance will have a breakout. But just because we're breaking out these particular patterns here, where we see in the circle, doesn't necessarily mean that that's a breakout. So you have to understand that breakout trading can be one of these things that's very, very difficult, because markets don't break out every day. Okay, what they like to do is trend between support and resistance. When fundamentally and the technical signals come together, then we can have a breakout. But it's quite easy in some respects when the markets are more volatile and there's not so much trading activity to get people as a false breakout. So what will happen is, okay, this is acted as, let's get the drawings up. So this has acted as support here once, twice. So the third time, people are expecting some sort of break. So it actually breaks through. The people are going long and buying into this. But in fact, you need something to aim for, because you can't just buy the break of a level, because markets they're not that easy. They're not that simple. Every time we break to the market just went 100 ticks in a straight line, then everyone would be a millionaire. But what would happen in this instance is the market looks to break, okay, but then immediately, as we start to make these highs, people sell into that strength to find the value and push it back into the range, okay, and just take that profit. So you have to understand that you can't just look as black and white as when support is broken, that again, or the resistance is broken, that becomes a breakout trade. You have to tie it in with other things. You have to tie it in with the individual candles. Were we trading in relation to the moving average? Okay, what are other oscillators like the RSI telling you? The RSI is a great one when you break out trading, because it should be to one extreme or the other. So if you're looking at a normal chart and you're thinking, well, there's a possibility this channel could break, okay, well then look at immediately your RSI, and that should tell you if the momentum's building up. So RSI, Relative Strength Index, okay, if it's over 70, if it's over 70, it's generally overbought. If it's below 30, okay, it's generally oversold. So you need to be on the right side of the RSI in order to let that breakout happen. So if you're trading here, okay, and the market's trading upwards, but the RSI is, really kind of mid-range at like, the 40, 45 mark, will there be enough strength in the market in order to push through and for the market to find new trading levels? So you need, again, a level above this, a target level where the market could push to. So it isn't going to be here, because that's too close to the initial breakout point. There'll be a level up here. There'll be the next point of resistance in the market. So try and gauge where you're trading right now. Look at something like the RSI and say, is that RSI strong enough, between the overbought and the oversold, in order to let buyers come into the market, find value, and pushing up to the next point of resistance? Okay, Drake, the RSI is the Relative Strength Index. Okay, so if you're using MetaTrader or using any charting package on IntraTrader, you can just bring up the RSI. So it's a range between 0 and 100. Okay, so below 30, okay, when the market dips down, that's generally the RSI is oversold. And when it's above 70, okay, that's when the market's overbought. So if we're above 70, okay, and we're at the top of the range, okay, that means there's an influx of buying into the market. Okay, so if it's overbought at 70, what's the likelihood of that we're going to break the market higher when enough people have already bought all the way up? So what you'd need is that the RSI to be, let me just get this the right way around. RSI to be over 30. It's overbought. So yeah, so okay, so it's over 70, yeah, and it's oversold up here, then you might get the opportunity to break up. But if it's not, again, it's all about putting it into context. I mean, use things like your Bollinger Bands, use things like the individual candles, use the volume indicators. Because if you're looking for a breakout, there has to be something else behind it, rather than that this is just a level of support that's held twice, so when it breaks through, it's going to go up 50 ticks in a straight line. The market just doesn't work like that. You need other confirming indicators to stop it from being a false breakout. Okay, so look at the size of the individual candle bodies. Okay, there should be small, leading to big ones that break through, because that's showing that every price is traded up until we hit new points of resistance. So the basics of a breakout. Okay, so what we're talking about in charting techniques is this. So we see the same scenario here. The market's holding between resistance here, holding between support here, and the market's just ranging sideways. But when we finally start to, move up to this point to break out, you can see how it looks differently from the rest of the chart. Okay, so people sell, buy back towards the midpoint, buy, sell, and it looks quite uniformed. When the market actually finally hits support here, okay, we close with a big green candle. Then after that, we see the momentum is pushing up to, towards this resistance again. But it's pushing up in a different way. Okay, it's pushing up. We get slightly smaller candles. They're a bit more uniformed. Okay, we try to make the highs with these wicks here, but we don't. But then when the market finally looks to break through, it does it in 3 candles. Okay, so it doesn't look back. So what the market is telling you is that, if you're going to look at it from a trading perspective, you've got, the low end of support. So really, when you've touched this line of support here, okay, the market really then finds good support about here. Okay, so every time the market has rejected the lows, we start finding value, a lot higher up the chart. So every time the market then hits down towards this second blue line, the market's gathering momentum. Then it finds more momentum here. Okay, once it starts to hit above this line of support here, it makes a new line of support here. So again, it's like almost in 3 stages. The market's told us down here that it's rejected these lows. It's momentum and looks to break out. Okay, it gathers speed. When it finally does break out, it does the majority of the up move, okay, for the breakout in 3 candles. So again, it's seeing the market act and seeing that it's gathering momentum, and it's gathering momentum further up the chart, because it's just the basics. Okay, it's just the basics. We've drawn this line of resistance in, we've drawn this line of support in. No more difficult than that. So we will have a moving average somewhere around here. Okay, so once we've stopped rejecting the push lower, okay, the market's looking for more buyers to come into the market. We'll be trading above the moving average, and as soon as really this indecision in the market comes here, okay, then we see a nice break upwards. Then once we broke out, we know we have to be patient. Then resistance becomes support on here, and the market then again moves higher. So again, I think the whole point is that you have to be patient with breakout trading. And when it has fundamentally broke, and they broke through and closed above that key level of resistance, that level then becomes support. Okay, so you keep buying along that line of support. Okay, resistance support, because that is then another part of attraction for the market. So again, it's a nice level. Okay, we've hit the highs 1, 2, 3, 4, 5, 6, 7 times. Okay, so you'd expect it to hit at least 1 or 2 times on the way down before it then continues to go up. Okay, so it's just bearing that in mind. When you get the initial breakout, that will be the key point of the volatility in the volume. But then the momentum will take a little bit more time to filter through and let the markets go as high or low as it needs to. Okay, Dan was just asking, what is the RSI figure? Okay, well the RSI, again, as I said, is a scale from 0 to 100, okay, that shows the relative strength of any instrument that you're trading. So it's either low down, okay, below 30, and that's the market overbought, or it's above 70, and that's oversold. Okay, so 50 would be the midpoint. So really, in general terms, between 70 and 100 is overbought, between 30 and 0 is oversold. Okay, so the market's oversold. We'll be looking for a turn in between them particular time frames. And I would say that you should look at your RSI on probably on your hourly charts, to be honest. I mean, look at if you're going to do an intraday trade, then your RSI is going to be most relevant on the hourly candles. But I generally look at the RSI from a weekly, daily, and monthly perspective. That's how we see on my charts that I've broken it down into. Okay. Is there a momentum indicator? Well, anything that we use, like volume, is a momentum indicator, I guess. But there's nothing really. When you know momentum when it comes into the market by the size of the candle bodies, and the speed in which a candle's formed, that's momentum. So there's there are different things that we can use together to confirm that we've got momentum. But the momentum comes in when you see a big, this is momentum, okay? When this market goes from the low to the highs here, and there's a big green candle, that's volume, that's momentum, okay? So that's what you need to look at, to be honest. And then your RSI is just another confirming indicator to kind of tell you if the market's overbought or oversold. And that will either give you a confirming that the market's likely to break out or not. Doesn't mean the market won't break out. But again, it's something to keep an eye on, because that's what we use with breakout trading. We use things like the Bollinger Bands, the key levels of support and resistance, and an RSI check. Okay? So the types of breakouts, okay? So the two main ones that we're going to feature, and that's continuation and reversal breakouts. So continuation breakouts occur when the market is trending, okay, and stops and takes some time to consolidate before moving in the overall direction. Okay, so we see that quite often in the markets. Okay, so we can see quite clearly this market is a bull market. Two consecutive higher highs. Again, we find good support then here, and the market moves up. But you're going to see, it won't be as exact as this example. It never is. But you can see examples in charts every single day where the market's moved up. It's then moved, again, green candle, red candle, again, just trying to test the lows but not really making much impact, trying to test the highs but not much impact. So what's the likelihood that's going to happen? Okay, the likelihood that's going to happen is that everyone down here, okay, is going to keep buying the market. So when it does filter through to this level of resistance here, that the overall momentum is going to continue. The market's moved 60 ticks or 100 ticks or whatever it is from the low to the high. You're going to expect the same on the move upwards, but you get that little bit of consolidation because people take profit, people take an opposite view. But again, as long as it doesn't come too far back into this range, okay, the likelihood is that the trend's your friend, and the trend will continue, so it'll go back up. Okay. So again, it's the key thing to remember when the market's consolidating is all things like people are locking in profit, people are liquidating the positions, and the volume's generally low because the majority of money's been made on the way up. So people are just profit taking. They're not aggressively selling the market and looking to push it back down. They're just taking the profit out, which means that the market really will just readjust. Okay, just readjust until it finds good support. And then when the buyers come back into the market, there must have been a reason for the market to push from here to here in the first place. So the consolidation is profit taking. They've no attempt made to go back into the range, and the overall move will continue because it still works. Okay, so the reverse breakout is in the other style. So that's just the market's going through a long-term trend, okay, and it stops for consolidation or a time to kind of catch its breath. Then the market's going to trade for a while, and then again do what it did in the particular. So it's all in the particular first place. So again, it's very much pick the trend. Okay, so the other way to look at this for me is that if the market's consistently moving in one direction, like it is here, trying to push down lower, okay, you're never going to see markets move in a straight line. They have to do things like this, okay, to come back up for profit taking and for people buying dips. Okay, so what all these points here, when the market has done all this, you know that at some point the market's going to have to calm down. It's going to have to move sideways. It's going to have a rethink about what it's done. So that's this period here. So it's very much like any kind of channel trading, any kind of counter trend trading. What you're waiting for is the market to hit support, hit resistance, have a think about what it's going to do, and then it's going to continue. So if it doesn't get back up into the range of like the 50% mark and significantly retrace what has happened, okay, then it's going to continue. So again, you want to use things like these breakout tradings with your Fibonacci, with your Elliott wave theory, and again, you have to understand what the market's doing and what it's done. Okay, so you break it down. The market's gone from the highs to the low. Okay, so say that for argument's sake is 100 ticks. Okay, it retraces here, people taking profit on the way down. Market comes even further down, people take some profit, it retraces, but it continues to move down. Okay, and when it finally reaches a key level of support, the market rethinks. Okay, it can't break these highs here, because if it was going to come back, it'd test a high here, and it'd test a high here. because that's previous levels of where the market's turned, gone back down, yeah, where buyers could have come back into the market to push it up, but didn't. Okay, so the fact that these lines, this level here, doesn't test here or here, means that the likelihood is the overall trend will continue. So when we fundamentally break this level of support here, the market breaks down, and you expect it to continue down pretty much at least 50% of this move here. So this is 100 ticks. You'd expect once it breaks out to go down another 50. Okay. So trading with momentum. Okay, momentum trade means that you go in with the order flow. Okay, the volume will pick up as you break a level, and again may set up stop losses. Okay, from people trading the extremes of the prior range of the move, which will help you add into the momentum. So if the market is breaking down lower, you know that people that are the long are going to have stops in the market to get them out if the market aggressively moves down. So then stops will be set off. And when you hear the terms like stop grabbers and the market getting out of weak positions, that's what it's doing. The market knows that people love to buy the bottom of the market, so it'll push it down to the first point of support, and then it'll hunt for the second or third level of logical support down there to get people out of the market. That's just the way they react. Okay? So the more levels of that range that are tested, the better the level becomes. So again, think of it as a coiled spring winding up until it breaks. And when it does break, it's going to test out as many levels as it can on the upside or the downside in order to see what the new value for the market is going to be. So remember, the momentum trades we carry are usually a risk-reward ratio of 3 to 1. So you don't need a big downside momentum trades, because you're either going to be right in going the momentum or you're not. Remember, stops are generally placed below or above the breakout to ensure that there's a retest of the prior level, so you don't get stopped out. Okay, so bear that in mind. And a good momentum trade will always go through a level, and it shouldn't really naturally come back quickly to retest it. It should be hunting again for that next logical support and resistance level and carry on with the momentum that's been built up. So another good way for trading breakouts is using things like triangles. Okay, so again, other well-known technical patterns that just basically show us the markets are moving in a structured manner. And when we get to the point of the triangle, that's when the breakout is going to be. So we can have symmetrical ascending or descending triangles, but they should always have two lines. So one is a resistance line, and obviously the other is a support line. So the closer they get together, the more likely we are to have a breakout at some point. Okay, so this is just another example of drawing a level of support and resistance in. Okay, so it doesn't have to be pretty. It doesn't have to be, again, that's the whole point of when we talk about technical analysis. It doesn't have to be the most amazing chart, and you look at it and go, well, of course I was going to do that. Try and keep your resistance and support lines pretty simple. Okay, the market starts to go up from here, and again, we find good support all along here. Okay, so that's fine. That's a valid trend line. Then the resistance line, again, it comes down, support, resistance, resistance, resistance. That's fine. So when they meet, okay, you expect the market. You can't always expect the market to get to the end of the triangle and break out, but we know that at some point it will. Now the overall, again, the trend is your friend. The trend is what we're going to be looking at. So the overall direction of the market, okay, is up. So it doesn't matter. We know the trend is up because we can draw a line from here to here and extend it. We don't need to know, if we're looking at this particular trade, we don't need to know what happens, okay, after this line. Okay, but we draw a line from here to here and extend it. So that's your level of support. You draw your line from here to here, yeah, resistance. Okay, so you know that at this point, the smaller the triangle, the further we get towards the end, the more likely it is to break out. So it doesn't matter that the market breaks out here and continues to go up. We know that, again, the overall trend is up, so we're looking for a break of that resistance line. Okay, we know that as soon as the market comes to a point, or as close as it comes to the point at the end, it is going to break up and continue the overall trend, which is up. Okay, so once we break up, again, we have to be patient. But look, the market then uses this level of resistance as support and continues to move higher. So if this is an hourly chart, you're going to have to wait a long time for the market to move up. If it's a 5-minute chart, you're not going to have to wait that long to get your profit. But the market, again, is moving up. So just by drawing in that simple support line, simple resistance line here to here, You're giving yourself a fighting chance that you know when the market breaks to the upside, it's going to happen at some point. Excuse me, in that triangle. So then you tie it in with your moving average, tie it in with your RSI, tie it in with any other indicator that works for you. But again, just for drawing a simple resistance and support line, you know a breakout is imminent, and it's going to be to the upside, so it will continue the overall trend that we've seen in the beginning. So things to check when you're trading triangles before a break. Okay, the support and resistance line you plot must touch the market, I'd say 3 or more times to make it a valid level of support and resistance. Okay, the stop placement for a breakout is usually placed above or below the broken line of a strong level. Never place it on the line itself, okay, because that's the point of attraction. It's too dangerous. Okay, and the break of a level is always stronger when it's supported by volume. And again, you can see volume because again it should be on generally your MetaTrader charts, or it should be supported by a solid red or green candle. That's your volume right there. Okay, so things to check on the break: are you above or below the moving average? Okay, if you're going to break out to the upside, you need to be trading consistently above the moving average. Be it 20 period, 50 period, doesn't matter. As long as you're trading above the moving average, you're putting the odds back in your favour. What's the size of the breakout candle body? As I said, if we break out, the point where the market breaks out above or below the market, that one candle needs to be a big, solid green or red candle. Okay, and then where's the RSI trading? Again, like I said, is it above 75 or 25? Okay, I generally say for me, it's 70 and 30. But if you want to be a bit stricter, then go as high as, is it above 75? Is it below 25? Is it overbought considerably, or is it oversold? If it's just in the range at 50, will that momentum be in the market in order to make that breakout happen? Possibly not. And remember, always check the close of the candle in relation to all of these, because otherwise you might see a fake breakout. Okay, so if you just see that the level of the triangle or the key level we're looking to break out, if you just see a long wick, okay, and that candle closes back within the range, that's probably a false breakout. So you either need to have got your position out, or again, be turning and reversing that position and going against it, because you need that candle to close well above the breakout point. Okay, because if it doesn't, then that will be a false breakout. So flag patterns, so again, these are two parallel lines that form before a breakout. And again, it gives you the support and resistance levels needed to break out of this range. So flags are continuation patterns. Okay, a tight range or pullback will form, giving the level to buy or sell through, because this is a continuation of the prior trend. So you're going to see things like bull flags, bear flags, bull pennants and bear pennants. They're pretty much very, very similar. When we go through them, you'll see why. Okay, so a pennant is just the same. So you're looking for a flagpole. You're looking for the market to tip its hand and tell you what it's doing. In this particular instance, in a bull pennant, we know the market's gone up. Okay, we're making higher highs. Yeah, we're making higher. We're not breaking the lower lows. Okay, so we know the market's going to come up. So we see that the market gains momentum. Okay, closes above this level of support we've got in, and we see this big, strong green candle indicating the market's going up. So then we see the market moves down and kind of consolidates, but it consolidates in a nice uniform way between support and resistance. Okay, so we can't make the highs, the market comes down. Okay, we can't significantly break lower and move into this range down here. So that's your bull pennant. Okay, so you just draw your support and resistance lines as you would. Okay, and because it's a continuation pattern, you look for the market to consolidate, to break out and continue the overall trend. Okay, so that's how you'd look at a bull pennant. Okay, and then a bear flag is pretty much just the same. Okay, but again, it's going to have two, instead of coming to a point as in the pennant, it looks more like, obviously, like a flag by having two parallel lines, almost like this channel. So the market aggressively moves down here. Okay, stops for a bit of thought here, goes back down. So again, once the market hits a key point of support, then we can draw these lines in. Okay, support and resistance. So you draw a nice one here of resistance. You know, it hits 2 points, can't make a high above here. Yeah, and we draw a nice line of support, 1, 2, 3, 4, 5. So when the market is going to continue moving lower, then what you want to be doing is selling these highs back into the range, and waiting for a fundamental breakout and a continuation of the down move. Okay, so that's an example of that. So using Fibonacci to trade breakouts. Now again, I've used Fibonacci a number of times in the live sessions, and it's something I'll generally draw on the markets a lot of the times. So again, you can't make Fibonacci work all the time. It's not designed for that. But when you see any kind of strong directional move, be it 100 candles on the monthly chart or two, what can I say, two strong candles on a 15-minute chart, as long as you've moved a big space, a big amount of distance in a period of time, then you can use things like Fibonacci to see where the market can retrace to. Okay, a few questions coming through. FTSE is around 40, but it's trending down since Cyprus kicked off, so you're confused. Right. FTSE is trending down because the UK is crap big time. Okay, some good fundamental analysis there, guys. The FTSE, anything has to correct. Okay, anything has to correct at some point. What goes up will go down. We've historically seen since the stock market's opened, they've continually gone up. But we see these big crashes, we see these big corrections. Okay, but it's not in anyone's interest for a stock market to crash. People's pension funds, people's wealth, the value of companies is all held within these instruments. So when the stock market gets sold off, that money just goes somewhere else. Okay, the money's not lost; it just goes somewhere else. Okay. Right, okay, so again, we're using things like Fibonacci. It's a great way to preempt future breakouts by using support and resistance levels. Okay, so again, key levels, as I keep saying, are the 23, 38, and 62. 50% for me is the one. Okay, I generally draw a line of 50% retracement on my charts of any significant move, because again, it will be tested within the markets. So look for these lines of Fibonacci to use them as breakout trades. Okay, so when they come out and the market hits a level of 50% retracement, okay, that it's hit to before, the market is likely to do one or two things. It's either going to break back into the range and back into that initial move, or it's going to break through it and go towards the 100% retracement of the move. So again, I'll show you an example. Okay, so this is a trade we're looking to identify, and again, what we're the overlying trend is up. So we see the market move from here to here. Okay, so we draw a Fibonacci from the low to the high. So that tells us the market has moved up in a strong direction over all these candles. 80% of the time, the market's going to look to retrace 50%. If it doesn't in that particular 80%, then it's going to have to hit a minimum, I would say, of 23.6. Okay, so what happens is the market is clearly moving up strongly. Okay, so we hit the 23.6. We can't break below it towards the 38 or the 50. So the overall momentum, the overall trend in the market is still up. So what happens is, as I said, support becomes resistance. Resistance becomes support. So as the market runs out of momentum on the downside, we just range. We range along this 23.6. So where's the breakout point going to be? Well, back to this prior high. Okay, so when the market does look to break out again and continue the overall trend, you'd expect it to move. This is 100 ticks, as I said. You'd expect it to move at least 50 ticks again when it breaks up. And the point of the breakout is this previous high. We've done the 50%. So we start going long as much as we can along this 23.6. As long as we don't close below it, we know that the upper end is going to be tested. If it breaks out and the trend continues, then that's our trade. So head and shoulders pattern, again, these are other things that we can look at in the markets in order to kind of understand if the market is going to break out or we're going to hold the support and resistance. So these form after a large trend and signal a reversal breakout. Okay, so the head and shoulder pattern consists of a left shoulder, a right shoulder, and a head. Okay, then commonly what we call the neckline, which is the overall level of support. So in this particular example, we see the market has moved up higher. Okay, so there's different ways of trading this and how you want to make your money. Again, this is just a nice, simple sideways trend. So the market's finding, we know this is, it depends how you look at this and how you want to trade it, shall we say. Okay, so there's three main ways to trade a head and shoulders pattern. Okay, once the market's rejected the high and come down here, we know that's the first shoulder. Okay, so very much like Elliott wave, very much like a continuation pattern, we know that the overall trend is up. So when we find significant support, the market is going to retest the highs and move higher. Okay, so this really, this move down shouldn't be more than 50% of the initial up move, and it shouldn't break below the neckline. So you can quite happily get long here, knowing there's a potential breakout. If it turns into head and shoulders, we know we have to make the head, so the market has to come down. So you're going to be getting your profit out above the break. Or, if you know that's a head, and potentially going to form a head and shoulders, you then trade into the short of it, knowing that if this is to be a self-fulfilling prophecy in charts, then the head here has to come back and test this line of support. Or you can trade it as the head and shoulders the third way. We see the shoulder, so we don't want to trade that. We just want it to make it the head. It makes the head, so we know that this our opportunity now is building up the third shoulder. Okay, so in order to be a head and shoulders pattern, which is a reversal pattern, we know this head, the head should not be made a higher high of. So for this to be head and shoulders, this point here can never go above the head. Okay, it can never break too far up. So it doesn't, breaks back into the range, and we know that we broke up here, rejected the highs, come back down, found support, so we know that this third shoulder should be the reversal pattern, and the market should break the neckline and go down. So that's the safest way to trade a head and shoulder pattern, when you know this area here, which is likely to make that second shoulder, okay, because that's where the momentum's going to be out. All the longs are going to be out, and people are going to go short to break that neckline. But there is opportunity to make money on the way up, here, because we know if it's going to be a head and shoulders, the market will break up higher, and an opportunity here to buy up back to the shoulder, okay, and then come down. So again, it all depends how you want to trade it. As long as you're aware of these things, they become self-fulfilling. How you trade it, again, is down to you. But if you understand the patterns and what they could look like, you can understand how they're going to trade. So notice how the market breaks up, forming the first shoulder and the head. Well, the market, again, this is how it looks like in a normal chart. So when we're drawing them in illustration modes, they look very, very clear cut. But this, again, it's just how any normal chart would form. Okay, we see the neckline here. We see that the market's moving up, finding support. Okay, so this point here, okay, that is a shoulder. Okay, this point from here to here is the head. Okay, next shoulder. More visual with these things, okay? They're never going to come and it's not going to be like a little smiley face. This is a head and shoulders, buy here, sell here. So you have to let the market do, does what it needs to do. So we know that the market is gain momentum, comes back, okay? Finds support down here, market moves higher. As it moves back down, it hits this level of support again, moves higher, but can't make these highs again, so moves down. So okay, so if it's fundamentally going to change this trend of moving upwards, then it's going to have to break this neckline. So the neckline comes in, the market breaks down, there we go, that's your trade. But again, there's different ways of trading. You can buy all the way up here, buy all the way up here, okay? Or you can sell into the head, buy back into the shoulder, sell the second shoulder into the actual technical break. So it's down to you how you trade it and how you look at breakout trading. But it has to do one thing, then another. How it does it, that's the art of trading, okay? So again, by building up your charts in this way and recognizing patterns, you'll be able to trade and pick and choose how you interact with the markets. Okay, so trading the head and shoulder pattern. So again, the risk reward on a head and shoulder pattern should be the highest point for the breakouts, because that's the pattern, signaling the top of the market. So if you want to go with a high probability trade, you're going to go with the second shoulder, because that is telling you it's a head and shoulders pattern. And if it is a true head and shoulders pattern, it has to reverse the overall trend and break in the opposite direction. So that's your safest trade. But again, you might be more aggressive and buy into each shoulder or buy into the high of the head. Again, it's down to you how you interact with the markets and how you use these particular trading patterns. Okay, guys, any questions about that? Any thoughts? I mean, once you see these patterns in the markets, and once you see the flags, the pennants, you're looking for that key point of consolidation. That's your ticket to the market looking to break out. If a market's moved 100 ticks and then consolidated for 20, then as that market consolidates, that's the point of when you want to be interested in. Overall trends usually continue. But when you see patterns like the head and shoulders, the key reversal patterns, again, you have to be patient. You have to wait. You have to let these patterns emerge and then pick how risky you want to be. Anyone can preempt any type of pattern. any kind of pennant flag, triangle, channel, but it will only work at the extremes, a very, very few times. So you have to be patient. If you're waiting for the market to consolidate and use your other indicators, you can purely just be a breakout trader, okay, and only ever trade breakouts, and you'll have a high probability of success, but you won't have a high trading frequency because the markets don't necessarily break out all the time. So you're going to have to watch out for all the false breakouts and all the false signals and trade the only true breakouts, or you're going to have to trade the opposite and go much more that the markets are generally going to trend. So buy at support, sell at resistance, and when that one time it does break out, get out the trade. Yeah, Daniel, I mean, again, like any of these particular trading patterns, again, they like to be quoted in the press, so people can get pulled out of these patterns. So again, if you want to be as safe as you can on head and shoulders, then only trade the very last shoulder and trade it as close to the neckline as you can. Because it's either going to bounce off the neckline or break through. If you try and preempt it, there's much more room for the market to be manipulated to try and catch people out. Yeah, and again, John, you can relate any of these things to a moving average. I mean, again, a moving average is just a lagging indicator. It's just telling you what's happened over the last 20 days, 20 periods, 50 periods. So, again, it needs to be tying in with your opinion of the market. If you're looking for a market to break out on the upside, and it's trading below the 50-day moving average and the 20-day moving average, what the likelihood is that it's going to break on the upside? Well, it's probably not. So maybe that would be an indication of a false breakout, or the market just isn't ready to break out right now. Ryan, can you share screenshots on this platform? Not entirely sure what you mean by that, Ryan. Okay, and Ollie's just saying the dollar versus the yen forming head and shoulders, do I think? Not entirely sure. I'd have to look at that chart. But again, there's something to look out for, guys. The self-fulfilling prophecy. If it can be traded as a head and shoulders, and it looks that way, it generally will be. But again, you have to pick how you want to interact with the markets and how you want to trade that head and shoulders pattern. It's not necessarily going to break out as quickly or as accurately as you think. That's the whole point of being a trader, is being a detective, putting all these things together and then pouncing on the market at the right time and trying to get on the back of that all-important momentum. Okay, guys, that's pretty much it for that particular session tonight. We've got a lot more things coming up, guys, a lot more. Try and join me for my trading clinics, guys. That's where you're going to get the most value, because I'll show you what's happening in real time and put things like these breakout patterns into play. Okay, and it's just so hard to give perfect examples of these trading scenarios just off charts, because again, you have to see how the charts build up. If you want to follow me, guys, again, it's Steve Ruffley, at Steve Ruffley on Twitter. I created this hashtag Bob level, so break or bounce level, and I can't make trading any easier than that, guys. I will tell you each day of where the market's going to move to. The market's either going to break through this level or bounce off it. Okay, so it's about as easy as I can make trading. Okay, how you trade it is entirely down to you. But look out for that, because I'm going to do them every day, and they do work. I know this because that's why I've made money over the years. Alright, guys, well, listen, anything else, you should know my email address by now, steve@intrade.com. Anything else you want to know, guys, you can always get hold of me. Keep an eye out for the trading clinics on FX Street and investing.com. And again, guys, anything else you want to know, I'm always here to help out. And, I only bring you these kind of educational webinars of things that I think are useful and to look out for. So, again, be aware of your patterns, be aware of the markets consolidating, and be aware of how you can trade breakouts. Alright, guys, well, listen, pleasure to see you guys as usual. Thanks to the regulars, nice to see some new faces. I will see you all very, very soon, guys, and thanks for attending. Okay, see you soon, guys.